The entire global economy is a ticking time bomb. It's a system that is designed to constantly devalue your savings. We're getting closer and closer to the countdown hitting zero, and there is no way to defuse it. In this video, we're going to explain exactly what the problem is, why there's no stopping it from happening, how the US is trying to fix this, how history is repeating, and what comes next. So, what is the problem and why is there no stopping it? Well, the money is broken. The financial system from top to bottom is built on debt. It's a house of cards where each card is debt stacked on top of more debt. And because of this, expansion of the money supply, i.e. inflation, is required for old debts to shrink in value relative to the new, bigger debt that's issued to pay off the old, smaller debt. It's this mechanic of inflation continually shrinking debt by creating more that allows the system to function. Economists that grew up inside this fiat money paradigm will tell you that inflation is necessary, and they're right. Inflation is necessary because the system is built on debt. History shows us that debt systems always collapse, and the consequences are catastrophic. This fundamentally broken monetary design creates perverse incentives with devastating consequences. As cash loses purchasing power, you are forced away from saving and into riskier investments or more debt just to preserve wealth. This fuels asset bubbles, drastically pricing essentials like housing out of reach and causes exploding inequality. This relentless financial pressure isn't just numbers, it's driving health crises, rising suicide rates, making basic stability and starting families tragically unaffordable for countless people trapped in a system designed against savers. But before we dive in and look at the wiring of this global financial bomb, there's a few concepts I'd like to quickly explain first that are important to understanding the bigger picture. Leverage. Leverage in finance is the practice of borrowing money to invest or buy an asset. For example, if you have $1,000 and borrow an additional $9,000, you can invest $10,000 total, creating a leverage ratio of 10 to 1. This amplifies your potential profits, but equally amplifies your risks. If the investment value drops, your losses increase significantly. Highly leveraged systems are vulnerable because even a small drop in asset price can trigger a domino effect, quickly causing massive financial losses. Interest rates. The best way to think about interest rates is like a tap. Just think of tightness. Low interest rates equals low tightness. The tap is loose, money flows freely throughout the economy. This means more money in the system, i.e. more debt, lots of economic activity, and lots of growth for the economy. High interest rates equals high tightness. The tap only drips a little bit of water now. As there's less money in the system, the economy contracts, meaning less growth or even possibly a recession. Inflation. In Roman times, they'd clip the edges off of gold and silver coins and mix in cheap metals like tin, nickel, and copper. This meant more coins could be cheaply created, but this devalued each coin as they were less pure. In today's era of fiat paper money, more notes can be created instantly out of thin air, both digitally and physically. This devalues every other note in existence, making it worth a little less. However, monetary debasement is different from the government's inflation metric. They use a metric called CPI, Consumer Price Index, which conveniently excludes things like housing, energy, food costs, creating a deceptive picture of economic health. Since the year 2000, government CPI inflation has increased by 88%. However, actual monetary debasement, the true rate of inflation, has increased by 363%. And this is the crux of the problem. A debt-based system which requires inflation means a constantly devaluing currency. The economy is a house built on sand. A great analogy for this from Michael Saylor is that companies and individuals in this economy are like type 1 diabetics. They're unable to store economic energy. A type 1 diabetic could eat as much as they possibly could and still starve to death because they're not able to store energy. Companies that capitalize on US dollars or US treasuries, and that's a lot of them, are losing economic energy due to inflation, and that's making them sick and creating this cancer-like mentality of growth at all costs. And so far, the solution to all of these problems has been to print more money, to keep the system going. But people are slowly waking up to the fact that this solution is the problem. Okay, so let's open up this bomb and take a look at the wiring. The US government is currently $37 trillion in debt. Who are they in debt to? Anyone who buys it. When governments run deficits and need to borrow money, they issue bonds. Anyone can buy a bond. An individual, a company, even other nation-states buy bonds. For example, if someone bought a 3-year bond for $1,000, then in 3 years' time, the government pays the $1,000 back. And each year until then, the bondholder would receive interest payments, also known as a coupon, yield, or fixed income. So the US government is $37 trillion in debt, and they have to make annual interest payments on that debt. At just over $1 trillion, the interest payments are currently so big that they are the third biggest item that the government spends money on, even more than defense spending. Not only is the debt growing exponentially, but the interest payments are growing exponentially alongside it. Here's the problem with this though. The US needs their economy to grow in order to pay off the interest. Here's an oversimplified example. If the economy grows by 3% and interest payments are at 4%, then there's a 1% shortfall, and they need to borrow even more money and take on even more debt, and that makes the interest payments higher, meaning that even more growth is needed in the future to make up the difference. It's a runaway train with no way to stop it. To solve this problem, you guessed it, they print money. Because raising taxes is political suicide, more and more we hear calls for austerity, spending cuts to try and reduce the deficit to slow the growth of the debt. Well-intentioned goals, but in this environment, cutting spending is like performing brain surgery on a marathon runner mid-race. As US Treasury Secretary Scott Bessent warned, cutting $1 trillion from a leveraged economy risks triggering a deflationary spiral that could be impossible to stop. In a debt-based system, deflation is the enemy. Why? Because when you take on debt, you're promising to pay back a fixed amount of money in the future. But if the value of money rises, if deflation sets in, then that debt becomes more expensive and harder to pay off. You need constant inflation just to keep the treadmill moving. And if you're wondering what the next collapse could look like, here's a hypothetical. In 2008, the world woke up to the fact that strippers in Vegas owned 7 homes. Mortgage lenders were lending to anyone and everyone, and the crisis ended up on the books of Wall Street banks, who were holding trillions of dollars in highly leveraged financial products called CDOs, which is basically just a bundling of financial products related to the real estate market. A liquidity crisis turned into a solvency crisis. As their assets lost value, they realized they didn't have enough money to pay back their debts. Trust in the system evaporated. And as always, the Fed stepped in, they printed, they flooded the market with money, they stabilized at the cost of massive inflation. But they haven't solved the problem, they've only kicked the can down the road. The next crisis will be much bigger, because the leverage in the system keeps increasing and the shocks to the system get exponentially larger each time. In the 70s and the 80s, credit card mailers exploded across America. Then in the 80s, Michael Milken created the junk bond market, unlocking new forms of leverage. In early 2000, we had the dot-com crash, stocks tanked due to loss of confidence made worse by leverage. By 2008, we had the real estate collapse, building up risk and selling it to whoever would buy. And now, we're sitting on the sovereign debt bubble, the final bubble, the everything bubble. All of this was made possible by the Fed cutting interest rates to zero between 2008 and 2015, and again from 2020 to 2022, encouraging everyone, everywhere, to leverage up, debt upon debt upon debt. Big hedge funds are already trying to deleverage, down from 25 times leverage. They know what's coming. In early 2025, when Trump announced global tariffs, the markets crashed. Normally during such a downturn, investors move money from riskier assets like stocks and buy safer assets like US government bonds instead. However, this time, investors sold US bonds, demonstrating a lack of confidence in the US financial and economic situation, and a lack of belief in their ability for the bonds to hold value over the long term. This is highly unusual and a big red flag for what is to come. Because bonds are government debt, the US government needs people to buy its bonds to be able to fund their deficits and their borrowing. If people stop buying US government bonds, the Federal Reserve would be forced to step in. They wouldn't have a choice. They'd resort to a tactic called yield curve control, which is basically printing money to buy government bonds in order to fund the deficits and keep the system going. But here's the catch. This strategy is insanely inflationary. This wouldn't just be a one-time thing. The Fed would have to continuously print more and more money every year to pay for the government deficits. This would mean endless money printing, no matter how much inflation it causes. And when that happens, investors will rush out of bonds and into hard assets, especially gold and Bitcoin. This is why Bitcoin's short-term volatility doesn't scare Bitcoiners, because the long-term instability of the dollar system is mathematically inevitable, and the flight to hard assets is just a matter of time. When does this happen? No one knows. It could be later this year, it could be in 3 years' time, it could be in 10 years' time, but very likely within the next 10 years, if not sooner. Time is running out. So, how do we fix it? There are two schools of thought. Camp 1, austerity and national resilience. People like US Commerce Secretary Howard Lutnick want to cut $1 trillion in government waste. His plan, supported by Donald Trump, includes using tariffs as leverage, saying to foreign companies, if you want to access the wealthiest consumers on earth, Americans, then bring your manufacturing here, create jobs, strengthen our national security. It's a compelling vision, but it takes time. You don't rebuild industrial infrastructure overnight. Camp 2 says inflate or collapse. On the other side, you have voices like Luke Gromen warning that cutting $1 trillion could break the entire system. He argues that in a debt-based economy, austerity doesn't work. It triggers a deflationary spiral, rising inequality, and potentially even civil unrest or civil war. His answer: print money, inflate your way out, because in this system, it's the only path that doesn't immediately collapse the entire house of cards. Treasury Secretary Scott Bessent is saying, imagine if inflation spikes and we start paying American workers $19.50 an hour to make products in Ohio. Someone in Middle America who lost their job to offshoring decades ago might finally feel heard. They'd look at people in LA or New York and say, stop whining. We've been suffering for years. We lost our jobs. Now it's your turn to take a hit. Trump and Lutnick's camp are betting on that sentiment. They're saying, we heard you, you elected us, and if fixing this means the stock market drops 20 to 30%, so be it. We'll rebuild the middle class and take the pain now. But Luke Gromen would fire back, sure, but you're playing with fire in a system built on debt. You're going to blow up the economy before you can fix it. The Fed will be forced to print money to buy bonds just to keep this from unraveling. And that's the punchline. No matter which plan we follow, austerity and onshoring or inflation and stimulus, the end result is the same. Massive money printing. Because the system was never designed to survive such a pullback. It only survives by pushing forward, faster, harder, with more and more debt. This isn't a left versus right issue anymore. It's the bottom 90% of the population versus the top 10%. While politicians like Bernie Sanders recognize the struggle, they miss the root cause. It's the inflationary debt-based monetary system itself that's fueling inequality. And that's why investors are looking for where to put their money that is safe and sits outside of the system entirely, something like gold and Bitcoin. Let's take a moment to rewind to the 1960s, because what's happening today isn't new. Back then, the world's financial elites ran a scheme called the London Gold Pool. It was a coordinated effort by central banks to suppress the price of gold. The idea was simple: control the gold price and you control the narrative around inflation. But behind the scenes, it was pure leverage and greed. Here's how it worked. Banks would say, I've got 3 bars of gold, and then proceed to lend out 10 on paper. They built leverage positions, betting that nobody would actually come calling for their physical gold. But when inflation began to rise in 1967, trust collapsed. People wanted their real gold, not the paper claims, and it became time to collect. It became clear the gold wasn't there. The scheme blew up. It was effectively a Ponzi scheme, a house of cards built on leverage and deception. In Weimar Germany, people trusted government bonds once, but they wouldn't be fooled twice. This time, there are far more accessible flights to safety. But the next crisis will be systemic, and it won't just touch Wall Street, it will hit the nation-state level. So now, In 2025, the same warning signs are flashing again. For years, gold has been in a sluggish sideways market, but recently it's breaking out. Why? Because people and institutions are once again demanding physical gold, just like in '97, the cracks in the system are starting to show. If you go to a London bullion bank today and ask for delivery of physical gold, it can take 8 to 12 weeks, nearly 3 months to receive it. Now compare that to Bitcoin, settle and secure it in 10 minutes. Over the last few years, central banks in Asia have been buying gold and silver aggressively. In early 2025, JP Morgan moved even $4.8 billion worth of gold back to New York. This smells exactly like the London gold pool all over again. And in the next financial crisis, when trust breaks down and inflation spirals, the world is going to be forced to reckon with just how fragile the legacy system really is. The world will scramble for assets with no counterparty risk. This won't just be a liquidity crisis, it will be a solvency crisis. People won't just ask, do I have access to my money? They'll ask, will JP Morgan be able to pay me back? When trust collapses at that level, people will run, not walk, to Bitcoin and gold. And here's the difference. Bitcoin is easier to buy, easier to store, and easier to verify than gold. In a digital age, speed matters, friction matters, and Bitcoin wins on both fronts. Here's the reality. The world holds about 1,000 trillion or a quadrillion dollars in assets, and over 300 trillion of that is tied up in bonds. If the Fed steps in and holds bond yields at 2% by continuously printing to buy the bonds, while at the same time inflation is running at 10 to 15%, no rational investor will touch those bonds. It's a guaranteed loss. You'd be locking in negative real returns for years. In this high inflation environment, to preserve your purchasing power, just to stay even, you'd need an 18% return on your investments annually. Not to get ahead, just to not fall behind. So just to recap the problem, the US government debt and interest payments are growing exponentially and faster than the economy can grow to pay it down. Cutting spending is not an option because that could cause a deflationary spiral which would crash the global economy and require the Fed to print money to keep the system going. The alternative is to print money to keep the system going, which would see the debt spiral out of control and lead to extremely high inflation environments, a fail of trust in bonds, a flight to sound money like gold and Bitcoin, and eventually cause hyperinflation as the world loses trust in the dollar and follows along to sound money. As economist Lynn Alden would say it, there is no stopping this train. All roads lead to inflation, and inflation leads to sound money. Bitcoin is objectively the best sound money. Bitcoin is not just another asset, it's a mathematical protocol built on top of the internet itself, TCP/IP. It represents truth, fairness, and most importantly, no counterparty risk. Bitcoin and gold are the only truly non-counterparty forms of money on Earth. They're not promises to pay, they're money in and of themselves. And when the system eventually breaks, which many believe could happen within the next 3 to 10 years, people will scramble towards assets they can actually own. Because when trust in the system fails, ownership is everything. Gold will probably do very well, but Bitcoin, with its perfectly limited supply, global accessibility, and trustless, permissionless nature, will go parabolic. If this scenario plays out, Bitcoin hitting $1 million per coin won't be some distant fantasy, it will be a logical outcome of a broken system. This is why Bitcoiners willingly ride out volatility. They aren't here for short-term games, they're playing the long game, protecting their wealth from a mathematically inevitable collapse of the debt-based system. Bitcoin is the hardest, scarcest form of money the world has ever seen. In 1967, the run on gold broke the system. In this decade, the run on Bitcoin will break the debt-based system. Thanks for joining me on this journey today. If you have any questions, drop a comment, like, subscribe, and see you in the next one. Thanks for watching.